Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Monday morning. All right, so let's take a look at what we've got going on today. So first thing is that the European and UK markets are closed today, so they're still on bank holiday. So their holiday goes throughout Monday. They'll be coming back with that volume, with that size tomorrow. So there could be a pretty relative to the overlap of Frankfurt, Paris, London with, say, the New York session, relative to that, it could be kind of an illiquid session to watch. Nonetheless, we continue to be moving lower, not significantly so, sort of drifting lower in what would be considered no longer a downtrend. It depends on how today closes. I'll be monitoring the structure really closely today. Lower lows would probably keep us in the downtrend, but if we can keep a range of fairly normal 68% probability volatility and not necessarily close, I would say probably below the April 11 lows, pretty good chance that this is going to turn into bearish chop. It still most definitely is bearish chop. You can see on my daily chart of the S&P, red candles, that's red participation, that's bearish action. We're still below the white dots. That is akin to, although different in terms of coding, but akin to looking at, say, a exponential 200 period exponential moving average. So we're still below a lot of key levels. We're still below two levels of resistance at this point. Not time to get bullish yet, depending on the time frame, but on this daily time frame for longer term time horizon trades that are attached to the narrative of the S&P, I would be very cautious with any kind of bullish longer term, say, swing type setup. The same thing goes for the NQ, still very heavy, punching down lower lows and lower highs. The thing to remember about the NASDAQ is when we talk about high concentration weighting, that's what the Mag 7 always was. Was there anything inherently magnificent about them? No, it was these high concentration weighted stocks. You could throw ABGO in there for the eighth. These were all moving higher, and they were all so disproportionately weighted, not only in the NASDAQ, but in their relative sectors that, magnificent they became. When they lost their magnificent, clearly they've lost a lot of their swagger. You can see what ultimately happened to the broader averages. And thus is the cost and oftentimes sometimes misplaced confidence that a handful of stocks moving higher can give to an overall index. But nonetheless, gang, it's still time to be playing defense for the most part. What does that mean? I'm still going to be looking for swing trades. We started getting active again in the swing trades, overnight exposure in the sector secrets mastery once the volatility just got back to normal. I don't need an uptrend. I don't need a downtrend. Either is fine. Chop is tradable, but what is very difficult to manage risk in, and that is the number one job, gang. What is difficult to manage risk in is high volatility that exceeds the 68% probability. In other words, if I told you something goes from A to B 68% of the time, or at least that's the range it would remain in, 68% of the time, you'd say, oh, okay, I can build a risk management plan, and I can build a target, a profit plan around what is normal action. But what if I told you not only were we outside the 32%, we were going way beyond typical historical volatility? Now, all of a sudden, that maybe whatever the stop loss is that you use for options trading, or maybe that 3-4 point stop you use for S&P trading, all of a sudden you throw that out the window because it has no applicable, really tactical usefulness in an environment where we're operating so far outside the type of behavior that risk management plan was designed for. And those are things that we need to keep in mind when we're looking at the kind of price action that we're seeing. Normal volatility, absolutely tradable. Sorry, the dog. Hey. I know he comes every Monday. Thank you. The pool guy's here. Today was Bring Your Dog to Date Week. Yeah. All right. So where were we? We're talking about the Dow. Clearly, the dog does not like the downtrend. So if I'm taking a look at normal volatility returning down, and I'm looking at the way in which we're moving lower, so be it, right? Now, I will say all my cards on the table, we do have two open positions, and neither of them are actually long puts. One of them is long calls in Walmart. So we continue to be long Walmart in terms of it being not an uptrend necessarily, but notice the green candles. Once those candles on the daily chart go green, right? Once those go green, I'm not allowed to buy puts anymore. That is by design. In fact, a lot of times, if you're not thinking about your indicators, your, whatever you're running on your chart, they should really be in many ways a filter. It's not about allowing more things to be valid. A really good process actually optimizes for less things to be valid. It's almost as if your indicator should be a checklist, and more of the criteria that is met, the more likely there is for follow through in the direction of whatever that setup's probability is. Poor traders, poorly skilled traders, maybe even poor traders, find one reason. Oh, it's doing this, let's go get some. Really good traders look for lots of reasons. They're very patient. And there's no such thing as oftentimes a missed trade to an experienced trader. Either it met the criteria to whatever extent it needs to, or it didn't. And so you won't hear experienced traders talk about FOMO, because missing out implies that there was something that should have been done, could have been done, and wasn't, right? For me, I'll tell you how that works out for me. A lot of times, a missed trade is all the criteria that I want are met, the price criteria was met, and then lastly, the disappointing part of it is I just didn't get the fill. Maybe my bid was a little too aggressive. Maybe it was a very quick wick to my trigger. I just didn't get the fill, but the criteria was met. And that's a really important contrast between what experienced and inexperienced traders do. I don't want to say profitable and unprofitable, because plenty of clueless traders have spent years where the market went straight up and confused a bull market for brains. Profitability is one metric, right? You could have a profitable month, a profitable day, or even a profitable year. I remember teaching, and this was such a ridiculous time to be teaching, but I was teaching traders how to trade back in 1998, 99, 2000. Nobody was listening to a word I said. And I said, look, gang, this is a great bubble. This is not going to last forever. Learn some risk management, learn some position sizing, learn to follow your triggers. Oh gosh, they would just talk amongst themselves, and because everyone's accounts were growing like crazy. And again, confusing a bull market with brains. Most of those people, sadly, most, not all, didn't learn anything during that time, and then come to find out, wow, you really do need risk management, profit sizing, and discipline to set up. So that's always something that we want to keep in mind. Whether it's a tough market or a not so tough market. This obviously is a tough one. All right. So with that being said, Renee asks, curious if you use a trade tracking application for tracking analytics. Yes, Renee, I do. I started off many years ago using a software called Wingman Tracker. Still a big fan of that. I don't use it as often. I've also, and I'm going to mention all of them because there's no one that's perfect. There's just one that we may like the user interface of, or it just is one that we like. So after Wingman Tracker, I started using one called TraderSync, I believe. And there might have been one in the middle called TradeMetria. All of those were great. If you've watched any of my classes over the past, 6, 7 years, when we do classes, I show you all, longer P&L graphs and what kind of capital I started off with, what kind of capital I ended with, using the strategy that I was teaching. So many of you are probably familiar with Wingman Tracker and TradeMetria and TraderSync. And then after TraderSync, actually was one of our members in the Sector Secrets Mastery that said, hey, have you checked out TradesViz? And that was probably 3 years ago now, maybe, about 3 years ago, I'd say. And I've stuck with that ever since. So I've been a big fan of the TradesViz. TradesViz. And I like theirs a lot, and I've just stuck with it. Again, you know what the best one is? The one that you will use. So that's what I always tell everybody. That's why I mention all of them. Find the one you like. I would say if you tend to do mostly options trading with somewhat complex legging in and legging out, Wingman Tracker is actually really good. And I would say TradesViz is really good with that. Some platforms aren't great with the trade matching around multiple legs. But if you're just a straightforward long call, long put trader, any of like I am in a cash account, any of those will work. So absolutely. In fact, one of the things that I'll talk about from time to time, because we have that data in the mastery, is why time of day for trade entry matters a lot. In fact, I think I posted that the other day on my X feed. What did I post? Because I remember thinking about the fact that a lot of traders think the job is to be at the desk all day, and that's not really the job. Let's see, I did post this. There we go. Ever think about the power of knowing, move that out of the way, of knowing what time your trades were entered? And that's where I use TradesViz. So for me, my best day trading window is approximately 9:40 to 10:35, or just 9:30 to 10:30 if you just want to simplify it. And then for my swing trades, the best swing trades are the ones where I wait until at least the end of the initial balance, or 10:30 a.m. Eastern, to put those trades on. So there's a lot you're going to glean from doing something far more, look, P&L, superficial, right? Just whether or not you're winning or losing could hide a lot of mistakes under the hood. Win rate is relatively superficial, unless adding to that, you're looking at the average size of your winner and the average size of your loser. A lot of folks tout a very high win rate, but never talk about that. You can have up to a 60% win rate. And if your losses are larger than your gains, you will lose money in your account. And it's little math like that you'll see really clearly when you're using something like TradesViz. All right. So yeah, absolutely. So let's keep moving on with the other position that we have in the Sector Secrets Mastery today, as we start off the day, and that is gold. We continue to have our GLD calls. Those will be expiring on the 25th. So we bought those. I can tell you right now. Here we go. All right. So this was the update from Thursday. And we had our GLD 25 April 295 calls. We entered at 485. Now notice I put all the entries here. This is not an average cost. This is not something we added to lower the cost of the overall entry. Nothing like that. Because at the end of the day, this is where adding, again, creates a very superficial type of position. If I bought at 485 and I bought at 385, right? When I close out the trades aren't being closed out at the average. The trades are being closed out, depending on which one of those legs I'm closing. That's where the P&L is generated from. So be very careful getting into the trap, mental and mathematical trap of adding to trades and then seeing your average cost, but forgetting when you're closing out your trade, you do close out the leg of your trade at the price you bought it at, not the average cost. And so that's where I think it's really important to look at every single entry and realize every entry has its own stop loss. We scaled out once at 530, and we have scaled out again at 1270. And I don't know where T3 is ultimately going to be, but we're going to try to ride this thing for as long as we can, because it's clearly going to be, looking at where gold is today, Yahtzee. It's going to be well above that 1270 second scale out. And then that also brings up a really simple conversation of, okay, Rog, wait a minute, 3 scale outs? Yeah. When we enter, one of the main things to keep in mind, and this is part of the trading blueprint, is how many scale outs are we focusing on? Because that, in many ways, along with budget, is going to dictate how many contracts we buy. I usually recommend to my traders, if the budget can handle it, if the risk to the account can handle it, buy at least 3 contracts, because that way you can at least scale out 3 times. If you buy 1, you're going to the first target, and that's not so bad. That means you've got a very small account, very small risk tolerance. Look, you put the 55 cents in your account. 45 cents in your account, and you say, look, you know what? I built some confidence. I put some more cushion in my account. All right, second scale out. Let's say you can afford 2 contracts of $485 each. Now you're talking to some really significant gains. And if you can afford 3, well, again, this is probably going to be somewhere around $15, if not more. I'll have to see when we open. So depending on your account risk and your budget that's dictated by account risk, you should have multiple contracts. If you'll notice with Walmart, I bought at 2 different prices. Notice I didn't average it to 450, right? Each one of these was a predetermined trigger. So there was a trigger that was reached, and then I bought the May 1690 calls for $4.60. There was another trigger that was reached. So I bought the May 1690 once again. So these are all predetermined levels that we're buying at. These aren't ads because the initial position is losing money. I see that all the time. Oh, let's buy at 4. Whoops, we were wrong. Well, it's at 2 now. Let's buy it again. Don't do that, gang. If you watch any experienced trader trade, they will not add 2 losers, right? Either there were triggers that were determined beforehand and they follow that trading plan, they follow that blueprint, or they say, hey, my timing was too early, my timing ran into some news, whatever it is, and you cut the trade, right? So those are little things to keep in mind, and that's what we've got starting off our morning. All right, so the rest of the day is really going to be determined from whether or not we pull back in an uptrend and I can buy the dip, or whether or not we rally into resistance and I can sell the rip, focusing on the relative outperformers in each group. That's the job each and every day, whether it's day trading or not. That's always the job. Manage risk, wait for the setup. And I do emphasize wait. All right, Jawan asks about Palantir. Not interested in Palantir at the moment. Depends on the time frame, gang. So I'm going to presume you're asking about the daily, unless otherwise mentioned. When it comes to NVIDIA, I wouldn't touch NVIDIA right now. Not to the long side. It's not the downtrend it once was. It's bearish chop for sure. So the only thing I'm allowed to do in a stock like NVIDIA, or even a stock like Palantir on the daily time frame, is focus on the long side of Palantir, green candles, or the short side of NVIDIA. Now, again, there could be opportunities intraday. 918, don't know what those day trades are going to be quite yet. We could certainly put it on the watch list. And then that doesn't mean that there may not be some longer term setups, for example, with Palantir or NVIDIA, if you have more of a position trading mindset, which is one of the sessions that we do in the Sector Secrets Mastery. One of the things that we do uniquely in the Mastery is that we have a session every month dedicated to longer term positions. And those longer term positions are usually shares. They can also be leaps. We've been doing this particular session, the position portfolio session, since 2022. So this is a longer term portfolio that we've been putting together with the time horizon of months, preferably 6 or more, to years. And that's where I'd say Palantir is probably the most interesting. I would leave NVIDIA alone on that for now. And then if there is some clarity for a shorter term swing, that might be something that might show itself on a 1 hour. So remember, gang, depending on what you're looking for, time horizon wise and directionally, you might go to different time frames, not looking for them to agree, but saying, hey, I want to be a day trader, short-term swing trader, longer-term swing trader, or position trader. All right, gang, as always, thanks for joining me for Charts and Coffee. I'll see you tomorrow, same time, same station. Be good to each other, gang.